we're going to dive into a question that's commonly asked when we start trading area gaps. And that question is, do we continue holding after the gap has filled? Now, if you're not familiar with area gaps, go and watch any of my videos on that topic. It's a pretty easy topic. And if you want to figure out how to eyeball gaps as to find out which ones are area gaps and which ones aren't, I'm going to show you in a bit. But what I mean by fill the gap to our price target is when we see an area gap, we know what it means for that gap to fill. We're going to take this gap on Google as an example, because I'm currently trading this gap. The gap in question is this one right here. Now, this gap, by definition, fills when the stock hits the lowest part of the candlestick prior to the gap. Now, we can find out that exact price by going to stockta.com, putting it in Google, and if you go down to the bottom, it'll show you the open gaps. That's the gap on June 27th. The gap is from 790.33 down to 967. So the gap fills when Google hits 790.33. That's our price target. When we open the trade, when we think the gap is going to fill, we aim to hit that price. Now, if you're in my Copy My Trades program, just at damonvario.com, you can sign up for that. When I sent out this trade, I said, this is what we're aiming for. When we hit the area, when we hit the price that closes the gap, we're done with the trade. But personally, I don't always close that trade out because there are many situations where the gap continues, well, it's already filled, but the stock continues moving past the gap. Now, after it closes, after the gap closes, we're not doing a gap trade anymore. It's a completely different trade at that point. So at that point, I'm not even considering gaps, and I'm just going back to a thought process, which essentially I ask myself, if I were to open this trade right now, would I continue holding in the direction I'm holding now? Or would I reverse direction? Or would I think it's going to trend sideways? And that answers the question as to whether I should continue holding on the gap trade. So before we get into how I make that determination, I'm going to give you a few rule of thumbs on that one. But before we even get into that, I want to show you how I eyeball these gaps as to whether they are area gaps or breakaway gaps. Now, I have an algorithm that checks this for me, so I don't have to do all the dirty work, but I can eyeball these pretty well. I've been trading gaps for so long now where I see a gap and I know pretty much immediately if it's going to fill or if it's going to break away. And everything I see here is 100% in line with my predictions. So we're going to go ahead and look at all of the gaps in Google up to where we're at right now. Now, these methods I'm about to tell you are in my Gap Game Plan 2.0 program, which is not available for the public at the moment. Right now, it's exclusive in Vario University. When I put out a new course into Vario University, my newest courses always go into Vario University, which you can find on my website. You can just Google it. When those courses go in, the second newest course comes out, and because Gap Game Plan 2.0 is my newest course, that will be coming out after I put in the newest course. So for now, unless you want to sign up for Vario University, you don't have access to that gap trading method that gives you a strategy of trading gaps immediately after you see the gap. So here we are with the first gap in Google, and when I see this, I immediately feel that this is going to fill. In the Gap Game Plan 2.0, I explain in more depth, but right now what I'm going to tell you is how I eyeball it. And the basic guideline here is if it's a down gap, like we see here, and it's two red candlesticks, generally it's going to fill. You just have to memorize that. Generally it's going to fill. The psychology behind it is we have people selling off. Usually they are professionals, people who get the information first, see how that's going to affect the stock. They begin to worry and they sell it off. And then the amateurs follow suit, and that produces a gap. But because the amateurs have brought it to a lower than necessary extent, the stock tends to bounce back on the next 1 or 2 days, which is exactly what we saw here. So that gap filled at about this point, and as you can see, the gap, after being filled, did not tell the stock to reverse or even out. The stock continued moving upward in this momentum. Again, we see that with this one. This I eyeball as an area gap, and the reason is, even though, keep this in mind, when you see an up gap and it's red followed by white, that's generally a breakaway gap. Generally, what you're going to see is the stock moving upward, but there are a couple conditions that you also need to check before you assume it's a breakaway gap. One condition is you need a high volume. The volume on this day is rather high, but it's not that high. Here, I would be indecisive. This looks like a questionably high volume. The issue at hand is actually where the candlestick lies. And as you can see, this candlestick, I'm going to zoom in a bit. This candlestick actually covers some of the previous candlesticks. They're in the same trading area. We aren't in a new trading area, and that tells me this is and the gap is very small, by the way, and that tells me that this is probably an area gap. It will probably bounce back, it will probably fill, and then we don't know where the stock's going from there. So again, it looks like an area gap, completely correct prediction. Now, again, we get to this double red gap. That tells me it's going to be an area gap. It's going to fill after a couple days. So we see a couple days, starts to bounce back, it does fill. And in this case, it doesn't really go past the gap. So although I'm giving you rules of thumb for whether the gap is going to fill or not, I can't give you a rule of thumb for whether the stock is going to continue moving after it fills the gap, just based on the chart alone. I'm going to tell you how I predict it in a minute, but for the most part, the technicals are enough to determine whether the gap is going to fill, but they're not enough to tell you what's going to happen afterward. All right, so now we see the first possible breakaway gap right here. Red, white. Red, up, white. That is usually a breakaway gap. And again, it has to happen on high volume, and we see the volume on this day is quite high. And it also needs to happen in a new trading region. You see how this bar is not anywhere, it's not covering any of these previous candlesticks. That tells me that this is most likely a breakaway gap. And in this case, that's completely correct because Google kept moving upward, and again, a breakaway gap. Now, this one I would have incorrectly predicted because white, up, black on a high volume day generally is not going to be a breakaway gap. It sets a new trading region, and in this case, I usually don't trade because what usually happens is it trends sideways. We set a new trading region, but we don't set a new direction. So I would have stayed out here. If I had to bet, I probably would have bet that this would fill as an area gap, but the direction or the distance is so high, that it's so far, that I wouldn't even have guessed it to fill all the way. So this is a special case. This is one I would have stayed out of. But the rule of thumb here is up. When you have an up gap and it's a white candlestick before the gap and a black candlestick after the gap, generally that fills. The probability of it filling is higher the shorter the distance here. When you have a big distance like this, it's a special case. All right, so now we move into the last two gaps. So here we have red, up, white. Now that is the sign for a breakaway gap, but again, that white candlestick is not in a new trading region. It's covering the previous candlesticks. So that's going to be an area gap. That's going to fill. Indeed, it does fill. Here we have another gap, and you probably, if I were to give you a quiz, you could probably answer correctly that this is an area gap because black down black. Those are usually area gaps. Now they tend to bounce back a few days afterward. I always watch the candlesticks. So what I did was I watched this one until it got to where I felt it would bottom out. And the candlestick sign I got here was this big red candlestick with a white candlestick, and then we had somewhat of a confirmation here. That's called a bullish harami. That's when you have a white candlestick inside a black candlestick, and it's confirmed. You want a more conservative, if you want a more conservative time to enter that position as a bullish position, what you do is you wait for that to be confirmed. What that means is you want the stock price to rise above the higher of these two. So once it rose above there, I saw it heading above there. That's when I bought in. That trade I have. Well, I'll show you in Paint Net. That way I don't give away all my other positions. So when did I open that exactly? Well, we can't tell exactly when I opened it from here, but you get a good idea. I bought two of these calls. I spent $2,200 each, so that's about $4,500 invest. Right now, it's trading at $7,000. So the question here is because, and by the way, I'm making this video because a student asked me, do we just exit? Because right now, Google's already up. A lot of people would be happy with this profit, and they'd be able to walk away from the trade with a nice, healthy 60% ROI. And I admit it is tempting to walk away with this type of profit, but you got to keep the goal in mind. The goal is, we know with a very high probability that this gap is going to fill, so why not continue holding? Then the question is, well, if it's already going to move all the way from 920 up to 970 or so, won't that give Google enough momentum to keep it moving upward past the gap? And that's the question we're trying to answer. So you could aim for this 970. That would be the conservative play. Oh, and by the way, I didn't really answer that question as to when we got in. But here, let's look at it this way. The call is the $920 call. I probably bought at the money. So I probably bought when it was at 920. Does that make sense? Is that right? All right, don't worry about when I got in, but I could look that up. I'm not going to look it up, but I'm not going to bother. All right, so anyway, I know why I got in. I saw the candlestick pattern. I saw the gap. If you are looking for gaps to trade, by the way, make sure that you keep a watch list. Don't trade the day after the gap, because generally a down gap is going to fall for a few days. You want to watch the candlesticks day by day and then get in at a certain time. If I had gotten in here, I would only be breaking even right now. So it was important to see that continued sell-off and then get in when you saw the candlestick pattern be confirmed in the conservative case, or when you saw the candlestick pattern that's bullish in the more risk heavy case. Anyway, it's moving up. That's what we planned on happening. Now, once it fills, that's your time to get out. But that's the time I ask myself, is Google going to continue moving upward based on the fundamentals and the technicals? Now, fundamentally, what I tend to look at is the growth of one fundamental called EBITDA divided by EV. All you have to do, these are easily available on any stock you want. Find that, divide it by this. Calculate it each year, and you're going to get numbers. Hopefully they're rising. If they're rising, that's a pretty strong indication that the company is growing in a fundamentally important way. And what I mean by that is, we have a metric here, a fundamental metric that has been proved to have a correlation with future stock price. Many other fundamental metrics are pretty much useless. This one here, EBITDA to EV, gives you a strong fundamental trend. If it's growing year by year, then the stock is probably a pretty good hold. Now, because the fundamentals tell me it's bullish, I want to take a look at the technicals. There are two main technical indicators I want to look at. If they are also both bullish, or if 2 out of the 3 of these things I look at are bullish, I will probably stay in the trade. Otherwise, I'll get out. So for Google, we just looked at the EBITDA to EV ratio being bullish. And then I look at 2 more things. The first is the Chaikin oscillator, which you can just grab down here in stockcharts.com. Just choose it as your indicator. What you want to see is you want to see it in positive territory or encroaching on positive territory and moving upward. If it's moving upward, that's a good sign. It means the rate of change is upward. And if it's positive, that's a good sign because it means there's money flowing into the stock. And that's exactly what we see with Google. We had money flowing out for quite some time. It just crossed the zero line, which means money is only now flowing into the stock. And as long as it's on the uptrend, it means Google will see money flow in to its stock ever so quickly. So that rate will be almost exponential, and that is great for momentum. The second thing I want to look at is the ADX line with the directional indices right here. If we care about momentum, what we want to see is we want to see the green line above the red line, and that is not the case right now, but it looks like it will probably be the case by the time the gap fills. And if that's so, what that tells us is that the momentum trend has already shifted in favor of the bulls. Right now, we see a few candlesticks moving upward, but that's not enough to tell us that the momentum is in the bullish side. Once we hit that 970 level where the gap fills, I will go back and do that exact analysis I just showed you. I'll check the EBITDA to EV ratio. I will check the Chaikin oscillator, and then I will check the ADX and directional indices. And if 2 out of the 3 are bullish, I'll probably continue holding, and I'll play this as like a swing trade that are based on the technicals. But again, if you want to be a conservative trader, especially with these area gaps, because the area gaps are the most reliable, if you want a reliable trading system that doesn't require a lot of risk, your best bet is area gaps and close when the gap fills. I'm more of a risk, I have a bigger risk appetite than most traders, so I like to play the technicals after the gap fills, and that's probably what I'll do with Google. I mean, we've already made what? We've already made almost $3,000 on $4,000 invest. That's good for these short trades. I've only been in the trade for a couple days, but again, there's this temptation most traders have, especially at the beginning, to take profit and to stop losses. And I don't like either of those concepts. I like to determine where I'm going to exit at the very beginning of the trade and make sure I do it just as planned. Otherwise I'm playing too conservatively, and my profits won't be big enough. My losses will be more frequent, even though they're smaller, and that's just not what I'm looking for. I'm playing a very, very precise probability model, and that's exactly what I'm teaching people. I do have a conservative I have a conservative version of what I trade, which is why I say to my students, get out when it fills. But myself, I play a little more risky. So I just wanted to answer this question once and for all. What do you do after the gap fills? Is that definitely a time to exit? Well, the answer is yes, it's definitely a time to exit the gap trade, but you can still stay in that trade. Just don't see it as a gap trade. See it as a technical trade or fundamental trade, or hold it into the next quarter's earnings reports if you think the earnings play is going to be good. But don't say you're still in the gap trade once the gap is filled. Once the gap is filled and you're already up, just consider it as a really profitable or a really cheap entry into a different type of trade. Otherwise, get out and find something else to play, find another gap. You can be a fine trader. You can be a very profitable trader just trading area gaps. You don't need to have all these different methods. And in fact, when you first start out trading, I recommend you just stick with one method that works. And gap trading, especially area gaps that look like they're going to fill, is probably the best for new traders. So let's do a quick recap. This example here is I saw the double red candlestick going downward. That to me is a reliable area gap. After Google fell quite a bit, I saw there's quite a bit of range here for profit. If you buy an option with Delta 100, for example, that's going to give you $5,000 profit if you buy at the bottom. So I saw that this gap is going to fill. I saw that Google kind of evened out here. Then I saw the candlestick pattern, which was a bullish harami, where you got a white candlestick inside a red candlestick. The pattern confirmed itself on this day. So I opened a position. I bought some call options that were in the money. And now I'm holding for when that gap fills. When it does fill, I'm going to not consider what I'm holding a gap play anymore. Instead, I'm going to go and look at the EBITDA to EV ratio. I'm going to look at the Chaikin oscillators, and I'm going to look at the ADX line. And if 2 out of those 3 are still bullish, I will continue holding and convert my trade. So mentally, no longer is this a gap trade, it's a technical trade. But again, there's one issue you always got to keep in mind. My options expire on July 21st. So if you want to get out with some time value within those options, well, it's better to get out early because the options are decaying at a faster and faster rate as you approach that expiration date. And we can see right here the delta is negative 0.4 because I'm holding two of those. Essentially what's happening is I am paying $80 per day to hold on to that option. And if it's not worth it, if it's not worth $80 a day, I still got to get out even if I think Google is still going to be moving upward. So that's it. If this video was helpful, please subscribe and leave your comments below, especially if you have video requests. I make most of my videos based off requests, so if you can give me a request, it makes my job easier and it simultaneously answers your questions.